Split share funds, aka split corporations, are some of the most complex and difficult funds to understand here in Canada. Yet, in my opinion, they are the income kings of Canada and very well suited for my style of investing, the income focused style. So, it's important that we understand what these funds are, how they work before we invest in them, like everything else, right? So, back in August 2020, I released a video called Split Share Corporations Explained. So although the info in that video is still valid, it was one of my earlier videos, so the production value and the quality isn't that great. But just like investing, I've learned and gotten better as I go. So since this is such an important topic for income investors in Canada, I decided to make another updated, remastered version of the video, as I could finally say that I fully understand how these funds work. So today's video, guys, will be all about split share funds or split corporations. I will review everything you need to know about them from A to Z. How are they structured? What is the difference between the preferred shares and the Class A shares? Termination dates, unit NAVs, distribution policies. I will try to cover everything in this video and even show you a bunch of examples. So strap in because it's going to be a long video, but by the time this video ends, I promise that you will become an expert when it comes to split share funds if you watch the whole video. So a split share fund or a split corporation is essentially a closed-end fund with a very unique structure that invests in a basket of dividend-paying stocks. So the number of stocks, the theme or the sector of the stocks inside the portfolio can vary greatly from fund to fund. So there are some split funds out there that have 15 stocks, some that have over 25, and even some that only have one stock or one company. Furthermore, there are split funds that are sector diversified and some that are non-diversified. So a non-diversified example or a fund that's non-diversified would be a fund that only holds financial stocks, for example, like banks and life insurance. So it's just one sector in the fund, so it's not diversified. So why is it called a split fund in the first place? Well, that's because of the structure of the fund. Look at it this way, guys. You have a portfolio of dividend stocks at the top, and then it's split into two classes of shares, the preferred shares and the Class A shares. So this means that each split fund has two stock symbols or tickers when you look them up on the stock market. Some of them even have more than that, but usually it's two. So usually there's one for the preferred shares and one stock symbol for the Class A share. So although there's two different symbols or two stock tickers, they're both related to that main master portfolio of stocks. So why the split? Well, why have two separate stock symbols instead of one? It just makes things more complicated, right? Well, they do this to split or to separate the risk and the investment objective of the portfolio. So the preferred shares are the conservative, the lower risk shares that have priority over the Class A shares when it comes to the dividends of the portfolio and the assets of the portfolio, just like preferred shares in general, right? So they're called preferred in the first place because they are considered lower risk than the regular shares or the common shares of a company. So most blue chip corporations like Enbridge or Bell, for example, have common shares and preferred shares, which have different stock symbols, right? So the preferred shares are safer. They tend to have lower dividends than the common shares because the overall risk is lower. So if Enbridge goes bankrupt, for example, and the company has to liquidate all its assets, its pipelines, I guess, then the preferred shares have that priority over the common shareholders to the assets of the company, right? So it's the same type of deal with the split share funds, guys. When it comes to the preferred shares, they have high downside protection. They have first priority when it comes to the dividends that the main portfolio generates. So essentially, guys, the dividends generated by the stocks inside the master portfolio is used to fund the distributions of the preferred shares. That's how the preferred shares are able to give out the income. It comes from the eligible dividends, the dividends from the portfolio. So what about the Class A shares, aka the capital shares? How do the Class A shares work? Why are they so much more volatile than the preferred shares, and why do they have such higher yields than the preferred shares? So when it comes to the Class A shares, they basically capture 100% of the stock price movements, so capital gains or losses of the main portfolio. So this is where the leverage comes from, guys. The split structure causes a leverage effect. Stay with me here. So when they actually do the split, there's usually an equal number of shares between preferred shares and Class A shares. So if there's 1 million preferred shares out there, there's going to be 1 million Class A shares out there. They usually have to keep it even. So if the Class A shares capture all the stock price movement of the portfolio, whether it's up, so capital appreciation, aka stock prices going up, or whether it's down, aka stock prices going down, the Class A shares capture all of it and the preferred shares capture none of it. This is why, as we will see shortly, the preferred shares usually don't move at all in terms of stock price. They usually just stay at about $10. So this feature of the split fund is what causes the leverage effect for the Class A share. So if the portfolio rises, let's say 10% in terms of stock prices, the Class A shares should rise by 20%. So the leverage is essentially 100% on the Class A shares as it captures all the capital gains of the portfolio. And speaking of capital gains, let's not forget, of course, that split funds generate two sources of income, not one. So the first, of course, are the dividends of the stocks inside the portfolio. But the second source is the covered call income, right? So I won't get into it in this video as, but if you've seen my other videos on them and you're a longtime follower of mine, you know that the covered call strategy or covered calls in general is essentially the bread and butter of my income investing strategy. So if you have no idea what covered calls are, I suggest you watch my covered call explain video. But in short, it's a zero risk income enhancing technique to give investors more yield or more income while giving up some growth potential. So that's basically what it is. So the income that covered calls generate is not classified as dividend income. They're classified as capital gains income. So because there is such a huge leverage effect on the Class A shares and all the capital gains, including covered call premiums, goes to the Class A shares, think of it like double covered call income. This is why Class A shares have such huge yields. So in summary, the distributions for the preferred shares come from the dividends of the portfolio, whereas the distributions of the Class A shares come from the leftover dividends, if any, plus all the capital gains of the portfolio. So hopefully this made sense to you. Of course, we'll go through many examples later on so we could piece all this information together, so don't worry about that. Before we get into that, I just want to discuss the $15 unit NAV rule that most split funds have. I say most instead of all because I found one split fund in Canada that does not have this rule, but all the ones I invest in have it. So for me, they all have it. So every fund, as you should know, has a NAV price or a net asset value price and a market price or a stock price. And since there's two classes of shares with split funds, the preferred shares will have a net asset value or a NAV, and the Class A shares will have a net asset value or a NAV. So the unit NAV is both those NAVs together. So it's the NAV of the preferred shares and the Class A shares together. So it's the total NAV of the fund, basically, what the value is of the entire fund. So split funds have a specific rule in place where the unit NAV has to be $15, that's 1.5, or more for the distributions or the dividends to be paid out for the Class A shares. Preferred shares, not impacted at all by this rule whatsoever. They always pay the dividend no matter what. So this rule is probably the most annoying, the most negative thing that comes to people's minds, including my own, about the Class A shares of split funds, right? This is where the biggest risk is. You might miss dividend payments, although temporarily if the unit NAV is under $15. So what would cause this, right? Why would it go under $15 in the first place? Well, in case a correction or a crash happens, the Class A shares can lose a lot of value very quickly. This is because of the leverage effect we just discussed, right? So if the main portfolio value goes down 15%, let's say, the Class A shares can lose about 30% because of that leverage effect. So although many people get scared by this rule, I've learned to accept it because I kind of changed my view on it. So I see this rule as a fail-safe instead of something negative. So yes, during a stock market crash or a correction, some split fund Class A shares might start missing dividend payments temporarily, but it doesn't mean that the main fund stops generating income or stops generating covered call income. Income still gets generated, but it stays within the fund instead of being paid out to the Class A shareholder. So this helps rebuild the fund's value, the fund's NAV. So eventually it will rise above the $15 once again. So as the stock market recovers, as it always does after a crash, so does the fund, and the recovery is also quicker on the Class A shares because of that leverage effect. So if you think about it, in my opinion, this rule really ensures that the Class A shares remain healthy and alive for the long term, right? So this is why I view it as a fail-safe instead of something negative. Yes, it always sucks to miss dividends, of course, but keep in mind it's only temporary. But more on this later. Another feature that scares investors away from split funds are the termination dates, right? I get questions about this all the time. Split funds have a termination date or a wind-up date. Usually it's 5 years. So this means that after 5 years, and we're about to hit the termination date, two things can happen. Number one, the fund extends the termination date, usually by another 5 years, so nothing happens at all. And two, the fund actually terminates. Now, believe it or not, this is what made me personally stay away from split funds for a couple of months, because that's what scared me or annoyed me. What happens if the fund terminates? I don't want to deal with that, right? But if I could talk to my old self now, I would laugh in my own face. I've never seen in any case, guys, where a split fund actually terminates. They always just extend the fund for another 5 years. Why would they terminate the fund? Why? They make all their money with management fees, right? So can you think of any reason why they would decide to close the fund? I can't. If they close it, no more management fees. So why would they want to close it? I've never actually come across a split fund that has terminated. So why do they have termination dates in the first place, right? The $1,000,000 question. Well, after speaking with a few split fund managers, I found out that it's not because they intend to close the fund after 5 years. The opposite is actually true. Their intention is always to keep the fund going as long as possible, and if not forever. And it makes perfect sense, right? Because that's how they make their money. They can't collect management fees on a closed fund. So they have termination dates basically because they have to. Because of the structure, don't forget there's preferred shares, and I guess preferred shares by law have to have some sort of redemption date or wind-up date. So that's the reason, guys. It's not by choice. So this is why split funds keep extending and renewing after 5 years. Just look at DFN or SBC, for example. These split funds have been around since 2004, 2005, over 15 years now. So termination dates shouldn't scare you. They'll just renew it, guys. The chance of a split fund terminating, in my opinion, is slim to none. Okay, but what if they do terminate? Let's just take that scenario. What happens then? Well, the preferred shares, once again, have the priority. So the original NAV value or price, usually always $10 a share, is returned to the preferred shareholder, and the Class A shareholder gets whatever NAV is left, basically. As simple as that. Will you lose all your money or something like that? Absolutely not. But like I said, the chance of this happening is slim to none. So split fund termination dates, in my opinion, they're a red herring, they're a nothing burger, they're a fugazi, whatever you want to call it. I'm certainly not worried about it. So the last thing I want to discuss before I show you some examples very quickly are management fees. So I know many of you watching are obsessed with management fees, and that's completely fine. But the most important thing about management fees, in my opinion, is that the distributions that we get or the dividends that we get are net of management fees. So the fees are included in the fund's NAV, or the fund's NAV, basically. So it's not like we're paying fees from our account. You see it come out of your account. It's included in the fund, guys. So this is very important as an income focused investor, because in my opinion, it's all about the income, right? This style of investing. I buy, I hold forever without the intention of ever selling anything. I just want to collect that income. It's all about the income. So since income is net of fees, I'm not bothered by them whatsoever. But some of you are, so I'm obliged to tell you that split funds, for split funds, the fees are covered entirely by the Class A shares. That's right, the entire burden of fees rests with the Class A shareholders. It's just the way that this fund is structured. And because of that leverage, the fees can be quite high and actually increase when the NAV of the fund goes down, or when the fund is starting to lose value. So I will post an article in the video description below, as well as other resources, and that really will show and explain more in detail with graphics about this, because I don't want to focus too much on the fees. But in short, guys, in complete honesty, the fees can be considered pretty high on the Class A shares because of that leverage. But again, as an income investor, the most important thing to remember is that distributions or dividends are net of fees, right? And since all that matters is the income, I'm not really bothered by it. So now it's time to actually check out some split funds together, so we could try to piece all this information together. So let's check out some of my favorite split funds. All right, guys, so what we're gonna do now is go over 6 split share funds together. There's basically 3 big split share fund, there are 3 main split share fund providers in Canada. You have BROMPTON, Quadravest, and Middlefield. So we will check out 2 funds from each fund manager. So the first one I want to cover is GDV. This is the Global Dividend Growth split fund, or split corporation here. It's from Brompton Funds. This is actually my favorite split fund of all time, and let's explore this in detail. So the first thing you will notice is right here at the top, you have different sections. So just by the way, Brompton Funds, in terms of website design, best website design for split funds. So you have the Class A shares you see here. So the stock symbol is GDV. As I mentioned, there's a separate stock symbol for the Class A shares versus the preferred shares. So the stock symbol for the Class A shares is simply GDV. For the preferred shares, it's GDV.PR.A. So this is the stock symbol that you need to look up for the preferred shares, and GDV is the one for the Class A shares. So right now I'm on the Class A tab. So the closing price, everything has to do with pretty much the Class A shares. If you just click on this one, all the information has to do with the preferred shares. So we'll go back and stick with the Class A shares here. Closing price, so the market price, $12.70. The NAV, the net asset value. Okay, this is the NAV of just the Class A shares. It's not the unit NAV. It's just the NAV of the Class A shares is $12.64. So it's pretty much neck and neck. It is, the market price is a little bit higher, which means this fund is technically trading at a very, very small premium because the NAV is a bit lower, or a tad lower than the market price. So the distribution rate, or the dividend yield, think of it like your annual interest rate on the Class A shares, is a nice 9.45%. Management fee, 0.85%. And here you have the unit NAV. So the unit NAV is $22.71. So this is the NAV of the Class A shares, which is $12.64, plus the NAV of the preferred shares, which if we just click, it's $10.07, right? So $10.07 plus $12.64 should equal $22.71. That is the unit NAV. So way above the $15 unit NAV threshold, right? So as long as this number, guys, is above $15, the dividends will be paid out for the Class A shares. And then you have the total assets of the fund. So how much, what's the value in the fund total? It's $200 million. So if we go down, you'll get all the information. You obviously have the description of what this fund has. So like the name says, global dividend growth. So it has global stocks that are dividend growers, which tend to they're called dividend growers. So it's stocks that tend to increase their dividends over time. So if you just click on portfolio here, you have the entire breakdown. So you have the geographic allocation. This is just, this is not specific to split funds. It's all funds have, you have a geographic allocation, but GDV in particular is very, very, very well diversified, because not only is it diversified by geography or by region, so you have some US, you have Europe, you have Canada, but also by sector. So this is a sector diversified split fund, right? You have financials, tech, industrials, you even have real estate, consumer staples, energy, healthcare, materials, everything in here. So this is a really, really well diversified fund, and you can actually see the top 25 holdings or the top 25 stocks in this fund. We're not going to go through them one by one, but I want to show you other stuff. So this is GDV basically. And if we go back to overview and scroll down, you could actually get, the stock symbol of the Class A shares, which is like we saw GDV, of the preferred shares and outstanding shares. You see they're pretty much the same amount of shares between the Class A and the preferred share. And then you have here the maturity date. So this is, maturity date, termination date, whatever you want to call it. So this split fund's maturity date is June 30th, 2026. As far as the dividend policy is concerned, so for most split fund, pretty much all of them, it's pretty much set in stone what the dividend is. So for the Class A shares, for this one, it's 10 cents a month or $1.20 a share. So annually. So if we click on the distributions tab here, guys, this is where you could actually see all the distributions and also the tax allocation. So we're on the Class A share right here. So if you scroll down, you can actually see every month what the total distribution is. So as you see, it's always 10 cents, right? 10 cents a month. And for the newer ones, we don't have the classification. So we don't know what portion is return of capital, what portion is eligible dividend, what portion is capital gains, because they're newer. But if you start scrolling down, you will start seeing that some of them will have the classification. So we'll probably have to go back here a little bit. So if you just go back 2020, they should have all the information. So let's go to 2020 here. So yeah, so now we're in 2020. So you actually have, out of the 10 cents, what portion is return of capital. So for the December 2020 dividend, it's basically the whole distribution, the whole dividend is return of capital. Same thing here, same thing here, same thing here. So it's all return of capital, except for these two here, January and February, where it was about half return of capital and the other half was, I'm guessing, capital gains. Yeah, capital gains. So this is, you always go on the fund's website, guys, to see the classification or the tax classification of each dividend. But what I could tell you is for split funds, it's a big chunk in ROC, in return of capital, which a lot of people think it's a negative thing, but in my opinion, it's not. A little bit on that later, but you could actually see that here, right? The Class A shares, monthly distributions, primarily return of capital. So very tax efficient, because any distributions that are return of capital are not taxed. They lower your adjusted cost base. So it will increase your capital gains if you sell it later. But of course, that only applies in a non-registered account. If it's in a TFSA or RSP, you don't have to worry about that whatsoever. So this is the first split fund. Let's check out another one from BROMPTON, another very popular one from them, the Life and Bank Split Corp. So just like the name says, life insurance, bank, this is pretty much going to be a financial one. So once again, you have Class A shares, preferred shares. LBS is the stock symbol for this one. So the NAV is 1029. The distribution rate is 1178. So it's a lot higher than GDV. Management fees also a bit lower, but the unit NAV is $20.36, which is the NAV of the Class A plus the NAV of the preferred. 1007 plus 1029 will give you 2036. So nice and far from the $15. This is an older one, so that's why it's bigger, right? It's a past 600 million, whereas GDV was 200 million. Not that that matters, but you see here that this is where I'm gonna talk about this later, right? The higher the unit NAV, the lower the risk, but the lower the yield will be, right? So this one is a little bit lower, but the yield is higher. So this one only has, like the description says, the big 6 Canadian banks and the big four life insurance companies, right? So the big six Canadian banks, we know them by heart. And then there's a life insurance companies, which is Great West Life, IA Financial, Sun Life, and Manulife. And of course, the other 10 banks. So it's equal weighted. They're pretty much all equally weighted here. And once again, this is going to have a maturity date or a termination date. This fund's been around since October 17, 2006. So obviously, it's been a long time. They just keep extending the maturity date. So for me, it's not a problem. And once again, you could go ahead and, click on the distributions and see the distributions. And by the way, that unit NAV rule, where the dividend on the Class A is only going to be paid out if the unit NAV is over $15, they actually have it right here. If you scroll down and you click on this number 1 here, which was, where was it here? Here, number 1, distribution rate, right? Dividend yield, Class A shares, 11.78, but they put a little number 1. And if we go at the bottom and see, it actually says that no distributions will be paid out on the Class A shares if the distributions payable on the preferred shares are in arrears, blah, 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 blah. And then the NAV per unit would be less than $15. So there is that $15 unit NAV rule. So there's no dividend payments on the Class A shares if the unit NAV is less than $15, as well as whatever else they said, which is basically says preferred shares are always in priority, right? Which I explained to you. So this is another very popular split fund that I also own from BROMPTON. Let's check out one from another popular split fund provider in Canada, Quadravest. So this is by far their biggest fund, guys. It's called the Dividend 15 Split Corp. The stock symbol is DFN. Their website is not as well designed as BROMPTON, but the Class A shares, the stock symbol is DFN, and the stock symbol for the preferred shares is dfn.pr.a. So you could see what they have here. It's basically a portfolio of the best dividend stocks in Canada. So a lot of financials, all the big banks are there. Manulife is there, Sun Life is there, Thomson Reuters, and you also have Enbridge, Bell and TELUS are in here as well. There's TELUS, there's Bell. So a little bit more diversified than, let's say, the life and bank one, right? Which is just the best financials and the biggest financials in Canada. So this one is a little bit more diversified. Yes, very heavy on the financials, but a little bit more diversified. So if you scroll down, you could see the information. Here's the termination date, December 1st, 2024. All the information you need about the preferred shares, the Class A shares, which we've already discussed, right? Monthly cash distributions on the Class A shares, leverage to performance, right? Leverage, capital appreciation, attractive alternative to other income vehicles. They're missing an S here. So, and if you scroll down, you could actually see the unit NAV here. So here they don't have it as nice as BROMPTON. So the NAV pre-distribution, the NAV net of distribution. So always look at this one, because this is just saying that what the net asset value of the fund is after the latest distribution is going to be paid. So I always look at this one. So since they already considered it, that's why they're the same. So 1798, guys, this is the unit NAV. Okay, it's the entire NAV of the fund. So unlike BROMPTON, where you have the separation, you could actually see what the NAV is for the Class A, what the NAV is for the preferred. Quadravest doesn't really have that on their site. They only have what the unit NAV is. But since the preferred shares are always usually about $10, I simply just minus $10 from this number to get the NAV of the Class A share. So this is what I do with the Quadravest fund. So 1798 minus 10 equals $7.98. That is probably going to be the approximate value of the Class A share. So unit NAV 1798. So in this case, the unit NAV is less than the Life and Bank Split Corp, which is 2036, but the fund is a bit less concentrated. It's a bit more diversified. So it's not only about, I'm going to discuss this later, it's not only about what the unit NAV is, it's also about the portfolio diversification. Another one from Quadravest is the North American Financial 15 Corp. So this, like the name says, 15 financial companies. You have the companies here. So there's some US and Canadian companies, but they're all financial. So it's much more concentrated than DFN, for example. This one is very similar to LBS because it's just financials, but it also has the American ones, where LBS only has the Canadian one. So if you scroll down, once again, you could see the unit NAV here, 17.28. So it's just $2.28 above that $15 threshold. So there's the unit NAV is pretty close to 15, and there's concentration risk. So this is one that I would consider a higher risk, higher reward split fund, right? Another one, let's go to the Middlefield one. So Middlefield only has 2 split funds. We'll check them out together. They have the E Split Corporation, and this is an example of a split fund that only has one company in it, Enbridge. It's the only stock in this split fund. As you can see, enhanced participation in Enbridge, right? That's because you get leveraged exposure. So if you click on the NAV button here, this is where you will get the NAVs. So the Class A NAV is $13.94. The preferred one is $10.07. Combine these two numbers together, you get about $24, and that is the unit NAV of ENS, right, of this split fund. So $24 is way past the $15 minimum. So in terms of unit NAV, it's very safe, it's very high, but there is a little bit of concentration risk because it's only Enbridge. So yes, Enbridge is a very solid, safe energy company in Canada. It's not an oil and gas producer like we know. It's an energy infrastructure company, so it's a safer energy company, but still there's a bit of concentration risk here, right? So financial reports, top 10 holdings, which is pretty useless because it's just Enbridge. They have a fact sheet where you could read, obviously they're bullish on Enbridge. So that's pretty much it for this one, guys. They also have a newer one called the Real Estate and E-commerce Split Corp. This is awesome. It's just real estate companies. So if you go to the fact sheet, you could see what companies are or what REITs are in this fund, and you could see that it's really the best REITs in Canada, guys. You have Chartwell Retirement Residences, Northwest Healthcare Properties, RioCan, Smart Centers, Choice, Crombie, Killam Apartment REIT. There's also the Canadian Apartment REIT as well. There's 15. These are just the top 10. So really, really solid big cap REITs here. So really, really good quality. And then if you click on NAV, the NAV this is the highest NAV I've ever seen on a split fund. It's $19.10. Preferred is $10. So you add them together and you have over $29. So way past the $15 unit NAV threshold for this one, right? So these are 6 examples, guys. Let's just check out a couple of the dividend history of some of these. So LBS, I want to check with you. So like we saw, the yield is 11.88. This is today's yield. It's completely updated. It's 338. The stock market is not closed while I'm doing this video. So there you go. You just saw the price update live. But what I wanted to show you is the chart. So if you go to the chart, and I'm using my TD broker, you will actually be able to see here if the split fund missed any dividend. So as you notice here, during the financial crisis, you could see what happens to the Class A shares. They go down really hard and very quick, but then they go back up quick too. And you could see here that there's some dividend misses, right? Little pockets of months being missed or dividends being missed. The best example would really be in 2020. So in 2020, the financial sector crashed, and you have a little pocket here. You could clearly see where there's no little D's, there's no dividend. So we got our dividend for January, for February, but then the next one is in November. So there's 8 months of missed dividends here with LBS. So this is a good example. If you want to check out another one, you have FFN. We could just check out FFN real quick, which is also financial. So you kind of have even a little bit more than LBS. And you have, here's the pocket of missed dividends in 2020, right? So if you look at DFN, they missed a lot less dividends because they're a little bit more diversified. So they missed 4 in 2020, but nothing else throughout its whole history. So this is where it's important to look at what the fund has, not only just the unit NAV. And if you want to take a look at GDV real quick, they've never missed any dividends whatsoever. So, but this is a newer fund. It's only been around for in mid 2018. So unlike LBS, DFN, FFN, they've been around a lot longer. So here's the examples, guys. I winged it. I hope I covered everything, but this is basically how you, now that you seen the examples, you should know exactly what I'm talking about, right? You got Class A shares, preferred shares. You should know what the unit NAV is. and where to find it. Always look at what's inside the fund. I'll discuss that in a little bit. And you could also find, of course, the termination dates or maturity dates for each one, the distributions. I mean, even on, I didn't show you here, but you click on distributions, you will see the entire distribution history of the fund. So you see here, DFN, they paid out $20.80 of distributions or dividends total, compared to only $9.34 on the preferred. So the class A gets a lot more distribution. Same thing for FFN. If we click on distributions, you will see the total's 14, and on the preferred it's 9. And if you want to check out the tax information, you got to go to fund documents, and you could see the separation, or they only have 3 months here for 2020 filled out, but you could see what the portion is in eligible dividends, what the portion is of return of capital, etc., etc. So whenever you're doing research on a split fund, guys, always go on here, the official website of the split fund, to find everything. So there you have it, guys. Hopefully after seeing a few examples, you fully understand what I explained earlier in the video, right, about the structure. So now I want to discuss my personal tips, my personal tricks that I use in order to assess a split fund and determine if it's a good investment at any given time. So the preferred shares for me are pretty much pointless, just my opinion. Those are really designed for investors who are really scared to see their investment value or their account value go down and really want something super safe, and they're happy with 5.5%, because that's usually what the preferred shares of a split fund gives, about 5%, something like that. So in my opinion, for safety, there's better options out there like ZPW or ZPay, where you can get a little bit more yield and it's also low risk. I cover those types of funds in my safety ETFs video, so make sure to check that out if you're one of those scared investors or newer investors that fall into that category. The class A shares, however, is really where the magic happens, right? They have high yields thanks to those covered calls and leverage. So as an income focused investor, I'm obviously a big fan. High monthly income, super tax efficient income as well, just like we saw. A lot of it is ROC income. So unfortunately, many people still have the impression that ROC income is bad, that it's just your money coming back to you. Not true at all. And speaking of ROC, I'm working on another ROC video for you to fully prove this, so stay tuned for that. I'm hoping for next week. I'll try to squeeze it in along with an updated portfolio video, which I all know is your favorite. So go back to split funds. How do you decide which split funds to get and which ones to avoid? How do I personally assess the risk of any split fund? What are the dangers of split funds, and what is the worst case scenario? So let's answer these questions right now. So in short, there are 4 factors that I look at to help me assess the risk of any given split fund. So factor number 1, what is the unit NAV? The unit NAV is probably the most important thing when it comes to split funds. How close is it to $15, or how far is it from $15, right? The further it is from $15, the higher it is, the more leeway you have in case there's a correction or a crash. So obviously, the closer it is to 15, the higher risk it is. So if you have a split fund where the unit NAV is 1550 or 16, 1650, 17 even, I would consider that a higher risk split fund when it comes to missing income, because you don't have much leeway in case a crash happens. So if a crash happens, well, and the split fund unit NAV is 17 or 16, let's say, well, most probably it will go down if there's a sharp correction to 14, 13, 14.50, whatever. So it will go under that $15 and you'll miss payments. But what if the unit NAV is like $22, $24? Well, you got a lot more leeway, right? So the unit NAV, guys, is probably the most important consideration number 1 when assessing the risk of a split fund. But of course, don't forget, the closer it is to $15, the higher the risk, the higher the yield, the higher the reward. Factor number 2 that I look at, what's in the fund? Right? So what is the portfolio composition of the fund? Is it diversified? Is it sector specific? How many stocks in there? Right? So the more concentrated something is, for example, like we saw LBS, right? It's just financials. Well, the higher risk it is, because if something happens and financials are impacted, well, it's going to have a big effect on a fund that only has financials compared to another fund that has 50% financials and the rest energy and tech, for example, or whatever it is. So the more sector diversified something is, the safer it is. And the more concentrated it is, the higher risk it is. Of course, it depends really on the sector. So that's consideration number 2. Consideration number 3, and this is really not just for split funds, but for everything, the NAV price versus the market price. So I talk a lot about this in my videos, guys. So what is the NAV price and what is the market price? Is the NAV price a lot lower than the market price, which would mean that this fund is trading at a premium? So let's say the NAV price is $7 and the market price is $8 or $9 or $10. Well, that means you're paying $8, $9, $10 for a fund that's worth $7. So the bigger the discrepancy, the more you're paying a premium. So that's also a consideration to take into account when investing in a split fund and any other fund for that matter that's closed-ended, right? Because there could be a discrepancy between what the fund is actually worth and what the fund is actually trading for on the stock market. So right now, during a time where the stock market is high, there's a lot of funds that could be trading at premiums, which means the market price is higher than the actual value or the NAV price. So you've got to be careful with that. And consideration number 4, the last one for split funds, is what is the dividend history? Has a split fund missed any dividends in its history? We have the data now. You could go back 10, 15 years and really look at how many months have they missed. So that's very important to notice, to understand and look at, because it could dictate or tell you a little bit about the future. So if a split fund has been alive for a really long time, 10 years, 15 years, and they miss 0, 1 or 2 dividends, well, it's a pretty good sign. But if it missed 50%, 40 or even 30% of its dividends, well, that could be an indication to say this is a bit of a higher risk, a split fund, right? It's probably higher yield, but it's higher risk of missing dividends down the line. So those are really the 4 factors that I look at when I assess the risk or when I assess split fund, guys. Each one has its own weight. You got to put them all together to really decide and make the decision for yourself if the split fund is right or not for you. So now that you know how I personally assess split fund risk versus reward, it should be quite obvious to you that the higher the risk, the higher the yield, or the higher the reward, right? So it's time now to discuss the dangers and the worst case scenarios for split funds. So danger number 1 should be quite obvious: missing dividend payments during volatility or during crashes and correction. This is a no-brainer, right? So this is because of that $15 unit NAV rule that we discussed. So during corrections, during crashes, you need to be ready to possibly miss some dividends, although they are temporary misses. Once the fund recovers, once the market recovers and the fund goes above $15 unit NAV, they will start paying out again. But you could miss 1 month, you could miss 3 months, you could miss even, I've seen some split funds, even me personally, with LBS, I missed 8 months, right, in 2020 because it was all financials and financials took a dip. So it really depends on the 4 factors we just discussed, but that is definitely the biggest danger, in my opinion, danger number 1. Danger number 2 would be sudden price drops of the Class A shares, and that's because of the leverage, right? So if the market goes down 10%, 20%, the Class A shares will go down double because of that leverage effect. So for me, this is really a nothing burger because I'm a buy and hold investor. But if you're the type of person that will get stressed out over this, well, then maybe you should really reconsider getting split funds or really sticking with the lower risk ones. Danger number 3 is the death of the split funds Class A share. So this is extremely rare, but it has happened. I have 2 examples for you. So is it possible for split funds to take such a beating that the Class A shares never recover, the NAV never recovers, and they just stop paying the dividend completely? The answer is yes, and I have 2 examples to show you. So this is pretty much the apocalypse scenario for split fund share Class A shares, in my opinion. It's very rare. if you think about it. Let's go through the examples first, and then I'll talk about it in a second. So I don't want to scare you guys, but I just got to show you these two examples because it can happen. It's very rare. There are some split funds where the Class A shares pretty much die, in my opinion. So I'm on the menu for the Brompton ones, and you could see here, all the split funds. We looked at LBS, we looked at GDV, they have some other ones, but you could see this one here at the end doesn't have a distribution rate. It's OSP, the Brompton Oil Split Corp. So this is one where basically the unit NAV has never recovered. It's still way under $15. So there's no distributions for the Class A shares. There's only distributions on, it's pretty high. It's normal than the usual preferred shares, but that's because their preferred shares are getting everything. Where the Class A shares have basically died. So this split fund was only oil and gas companies. So because of, I guess, the oil crash in 2018, if we just check it out, no, that's another one, which I'll show you in a second. So because of the oil crash, I guess the split fund went down so much that the Class A shares, they're pretty much, they have no value. So the closing price is 240, but you see here the NAV is zero. That they have no value. So yes, they're still actively traded, but there's no income. So for me, this is kind of looks like the death of the Class A shares. The same type of thing happened with another fund called from Quadravest called the US Financial 15 Split Corp. So we saw FFN, the North American one. We saw Dividend 15, but there's one called US Financial 15, which is only American financial companies, right? The banks and everything. So we all know what happened if in 2008, right? The financial crisis, who got killed? Some American banks. Some of them got bought out. Merrill Lynch or whatever those Lehman Brothers, all those companies, right? So if we go to the chart, we can actually see what happened here on FTU. I mean, what a bad time to open the fund in 2005. They had three good years, but we all know what happened during the financial crisis. So you could actually see here just a huge plummet, and it never recovered. So this is another one where the Class A shares have essentially died. The preferred shares are still active. If we just go on the preferred shares instead, which is FTU.PR.B here, you could see that they stayed alive and they kept giving the dividends, right? So the preferred shares are always have the priority over the Class A shares. So these two was, I don't want to scare you. It's a very specific scenario, the oil companies and the US banks during the financial crisis. So this is why it's very important, and I'll show you this now. You need to consider not only the unit NAVs, but what the concentration is of the fund, what the fund holds. So that's the worst case scenario, guys. It's very rare. So it should not really surprise you that FTU went under because it was a non-diversified split fund packed with US banks, and we all know what happened in 2008. So they all got killed, right? So although FTU is actually still alive and traded, both the preferred and Class A, they don't give out any income anymore for the Class A shares for FTU. So only the preferred shares are giving out any income. So same story for OSP. It was very concentrated in oil and gas companies in North America, and they got killed in late 2018, 2019 when oil prices tanked. And since OSP has been is just oil companies, it fell like a pile of bricks, right? So just like FTU, it's still listed, and the stock price of the Class A shares is actually recovering. But because the unit NAVs of these funds are way under $15, the Class A shares have not generated any income for a while. So this goes back to what I was saying earlier, and why the unit NAV and what's in the fund are very major factors when considering investing in a split fund or not. The more specific, the more concentrated and less diversified something is, especially if it's concentrated in something high risk like oil stocks or the specific financial stocks, the greater the risk is, of course, the greater the reward. So you need to assess everything. All right, so now my overall opinion on split funds. So it should be pretty obvious that these funds were really designed for income oriented investors, not growth investors. So I basically love them. They're best suited for long-term buy and hold investors who have no intention of ever selling them and just want to collect high income forever. That's my opinion. So yes, the Class A shares, you could say that they could be used in swing trading to really capitalize on a sudden big loss in the market because they drop fast and they go back up fast. So a swing trader or an active investor could swoop in during a crash, pick up some Class A shares, which are leveraged, which will tank, and then sell them later on when the market recovers. But that's not what I do or what my channel is all about. I just buy and hold them forever. And if a crash ever does happen, I just simply buy more cheap shares to increase my income and my overall average yield. So in my opinion, for the regular everyday income focused investor, so yes, they want a really high income, but they want to be diversified and want a sense of general stability for the long term. Split share funds or split corporations should not, I repeat, should not make up the majority of your portfolio. But I can't say what percentage they should be in your portfolio, as this is really a personal choice according to your risk tolerance. Also, it's not just the percentage of split funds that's important in your portfolio, but which ones you have. Like we saw earlier, right, with all the examples, not all split funds are created equal. Some are high risk because their unit NAV is very close to $15, or B, they're very concentrated in one sector, but some can be considered very safe. Two perfect examples would be GDV and RS. GDV is extremely well diversified, plus the unit NAV is over $22. RS, although it's just real estate, contains the biggest and best REITs in Canada and North America, so very low risk REITs. And we could consider real estate kind of defensive. Plus, the unit NAV of RS is $29, so way past $15. There's a huge spread there. So if real estate crashes, well, it would have to crash by like 60% for RS to stop dividends. I just can't see it happening. So these two would be good examples of safe split funds. But something like DGS, where the yield is much higher and only has a unit NAV of about 1650, so it's a lot closer to 15. If the market takes a big tumble, there's much less leeway between $15 and 1650 than $15 and $22 or $15 and $29. So FFN would also be another example of a higher risk split fund because the unit NAV is something like 17 and it's not diversified. It's all financial. So if there's another crash, usually financials take a big hit. So you have concentration risk with FFN because it's all financial. So I think you guys get my point, right? You need to make the decision for yourselves using all the four factors that I discussed before. So it's not just about the overall percentage that split funds make up in your portfolio, but it's also which ones you have. If you have only the safe ones, the safer ones, in my opinion, it's okay if you have 30, 40, even 50% of your portfolio in split funds. But if you get tempted with all the high yields and the higher risk ones, and those are the only split funds you own, well, your monthly income will probably take a big hit during the next crash or during the next correction for however long it lasts. So if you're okay with that, that's fine, guys. I said it before and I'll keep saying it over and over and over. There is no right or wrong way to invest. There is no perfect allocation percentage guideline. The perfect allocation is the one that is best suited for you and no one else. So I get questions like this from newer investors all the time. Do you think I have too many split funds? Should I get less? Should I get more? There is no right or wrong answer to this question, guys. You need to assess your personal situation, your personal tolerance, and always think of the worst case scenario, which we discussed, right? So it's basically missing dividend payments temporarily. If you're relying on this portfolio to pay all your bills and living expenses and losing income for any given time would be disastrous for you, well, making split funds a smaller percentage in your portfolio or sticking with the safe ones is probably a good idea for you. But if you have a pension income, you have real estate, you have a big portfolio, you live in a paid off house, and you will be okay regardless, it won't really be a big deal getting less income temporarily when split funds stop the payments, right? So it might not impact your life that much or whatsoever. So it would be okay to get a bigger percentage in split funds and take a little bit of a higher risk. So it's all relative to your situation and your risk tolerance. Now, there's some minor things related to split funds I will cover in other videos I'm working on, like rock income and overnight offerings, which many split funds have done recently. So stay tuned for those videos. I'll cover those two topics soon. I also encourage you to watch and read other articles on split funds just to get a different perspective. I'll put some stuff in the video description below for you guys, including a quick video with Rob Lauzon, who manages the RS and ENS split funds on BNN. So he gives a little interview there on how split funds work, and he explains it beautifully in pretty much 2 minutes, not much details in there. Also, Brandon Beavis Investing, a very popular Canadian investing YouTube channel, just released a split fund video where his dad talks about them. I guess they were a little too complicated for Brandon, but that's okay. I'm just kidding. They got a good channel. I like their channel. I know many of you that watch me watch their channel as well. So check out their video, guys. I watched it and pretty much everything he says is correct from a technical standpoint. Unsurprisingly, they don't really like split funds much, as those guys are really more about total returns and stock picking, which is completely fine, more mainstream investing, which is not what I do. Obviously, I'm all about maximizing passive income, not total returns. So pretty much every single expert on BNN or whatever says to stay away from split funds and that they're dangerous, and just to get the individual stocks or passive index ETFs. No surprise. Of course, they will talk crap about them, right? These guys are active fund managers who usually focus on growth and total return. So I'm not surprised at all. I've admitted this, and I'll admit it again. These types of funds that use covered calls, and or anything that uses covered calls for that matter, will most likely underperform regular mainstream passive index funds, or even in buying individual stocks long term, 10, 20, 30 years from now. So when I say underperform, I'm talking about total returns here, which is growth or capital appreciation plus the income or the dividends, right? It's everything. So for me, investing isn't just about total returns. It isn't just about numbers. It's about using it as a tool to achieve financial freedom as quickly as possible, so you could enjoy life to the fullest as quickly as possible, because we don't live forever, right? So without this high level of passive income, guys, my wife and I would have never been able to retire in our mid-30s, and that for me has so much more value than overall total returns after 30 years. An extra 5 or 10% total return when I'm 65 or 70 years old is not that important to me, guys. Enjoying life to the fullest is much more important, but that's just me. If you guys want to maximize total return and growth, and you don't want or care or need passive income, you're pretty much on the wrong YouTube channel, right? So investing for growth, by the way, is a lot easier than what I do, because all you really need is maybe 5 to 10 index funds at the most, right? You could even just get one if you really wanted, the S&P 500 fund or VFV. That's pretty much all you need. But my strategy is really all about maximizing passive income to live your best life, not to achieve the best total returns. And split share funds, split corporations are definitely designed for this purpose. So I have other videos, guys, on split funds. I have specific videos where I cover specific split funds like GDV, which most of you know is my favorite split fund of all time, ENS, RS as well, the real estate one. So make sure to check out those specific videos as well if you're intrigued by these split funds. If you want to know what split funds I personally hold, so obviously the ones I have are the ones I think are the best, make sure to check out my latest portfolio unveil video, which I'm planning to do a new one in the next couple of weeks. So in that video, I show my whole portfolio so you could see exactly what I have from A to Z, including my split fund. So that's the end of the video, guys. Please hit that like button. I would really appreciate it. I know I tell you this at the end of every video, but for this video in particular, I really want you to hit that like button, because this video, we put in a lot of work between my wife and I, over 10 hours easy on this video to get you the most information we can on split funds. So I appreciate you hitting that like button. Make sure you're subscribed as well. If you like this content, this channel is all about income focused investing, how to invest for maximum passive income. So if you like this content, go ahead and subscribe. You won't regret it. Of course, visit our website, passiveincomeinvesting.ca, where you could access a bunch of free tools and resources, and where you could also pick up my digital product, the Ultimate DIY Investing Package, which I'm very proud of. It's on version 3. So this is basically a companion tool or a reference guide, whatever you want to call it, that for you to build, to help you build your own portfolio, whether you're Canadian, whether you're American. There's Canadian listed funds, US listed funds. There's no individual stocks per se, but it's really for ETFs, closed-end funds, and there's a special section, by the way, for split funds, where you could actually, I list all the split funds in Canada. There's about 25 of them, so you could compare them and see which ones I like the best and get all the information. So pick up the product if you haven't picked it up. It comes with lifetime updates, so you only need to purchase it once and you'll have access to the next versions that come out. The product also has sample portfolios, which I know you guys love. 7 sample portfolios for the US market, 7 for the Canadian market, all tailored for different types of investors, not only income like me, but also growth, dividend growth, etc. Also on my website, you could, right there on the homepage, you could book a one-on-one consultation with me personally, to ask me any questions, all the questions you have. If you want me to review your portfolio, you want my help to build a new portfolio or transition to an income focused portfolio, that's my specialty. So I'm completely booked up until the end of the month. I will open up more appointments in mid-December, so stay patient for that, but I will keep doing the appointments. Don't worry, I love doing it. I know they sell out very quickly, but I will definitely keep going with that. So my mission, the mission of this channel, guys, will always remain the same. It's to help everyday, normal, regular working people to invest on their own, DIY investing, so they could build their own stream of passive income, so you could enhance your quality of life and one day become financially free, financially independent, just like us. If we could do it, regular people, a regular couple in Canada, so can you. Trust me. So with that, guys, continue to stay safe, continue to stay healthy, take care, and see you next time.